John, the Henderson European Focus Trust, perhaps if we can start with what the trust does, so what its objectives are, in other words.
Its objectives is really quite simple, are quite clear, and that is to maximise total return over time. So to provide capital growth, but also a growing dividend is important to us as well. We'd like to progress the dividend. We continue to progress the dividend. We don't put that first. It is very much a total return strategy from between 50 and 60 European stocks.
Okay, so is the portfolio constrained by a benchmark, and what is its benchmark?
Well, the benchmark is something that we're very aware of. Investors will measure this trust against either the FT Actuaries Europe ex-UK index. It is an ex-UK portfolio. We don't buy UK names. Or they might look at it versus the Morgan Stanley Europe ex-UK, but any Europe ex-UK index, broad Europe ex-UK index is what it's benchmarked against. We're very aware of the construction of that benchmark, but we're active managers. We're not afraid of that benchmark. We're prepared to take significant decisions, deviations against that benchmark, and that's absolutely crucial.
How does the trust go about achieving its objectives?
The objective is to provide alpha, or to provide outperformance. And you do that not by hugging an index. You do that by being aware of where the index is, but then going on to back your conviction. And that's really what we do. So we do it by blending two things: sector themes with stock specifics. So right now, we've got 50-something names in the portfolio. We'll always have 50-something names in the portfolio. We'll never have more than 60 names in the portfolio. I want investors in the trust to say, please tell me about number 41 or 35 or 9. Why is it there? And it can only be there for one of two reasons. Either it's a component of a sector theme, for example, pharmaceuticals for the last 4 years, or it's there on its own merits. There's only one of two reasons for a stock to be there: a component of a sector theme, or there on its own merits.
So you, in terms of the region in which you focus on, where exactly are you focused?
Western Europe, developed Europe, mainland Europe, Margaret Thatcher's Europe, i.e. it doesn't include the UK, and I should update that, Nigel Farage's Europe.
Is there a constraint towards, or a bias, sorry, towards a particular capitalisation of stocks?
We'll always be largely large cap managers. But the beauty of an investment trust in particular, the fact that it doesn't get inflow and outflow, means that an investment trust, I've always believed this, my very first mandate in this business was an investment trust. An investment trust lends itself to less liquid names. I don't mean micro cap, but there are names in our portfolio at less than €1 billion in our investment trust. So it's all cap, but predominantly large cap.
In terms of the smaller capitalisation, are there limits as to how much of the portfolio you invest in those?
Yeah, we would typically be no more than 10% in small cap. Now, what do we mean by small cap? We define small cap as less than €1 billion market cap. Now, that might go up to 12 or 13 or 14, but at the time of purchase, we're seeking not really generally to exceed 10.
Is gearing an active strategy within the portfolio?
Gearing is quite active. The first thing I would say is that as cautious people, we don't like an awful lot of gearing. So our maximum gearing, in fact, enshrined in the trust is 20%. We've been up at 16, 17 under my tenure, and it goes down as low as 0 in terms of gearing. I don't use gearing to time the market. It's all about the opportunity set. If we like the opportunities available and they're available at the right price, we will let gearing go up. If I allow gearing to go above 15, I believe I'm then taking something of a directional call in the market, and I might cap it there if I'm worried about the market. But generally, I want it to be driven by the opportunities.
Now, you say that you look for inflections in stocks and also at a sector level. How do you go about finding these?
Yes, I mean, there are a number of... every fund manager should have his own DNA. and in terms of what drives the fund manager. And the DNA or the ingredients of me and us as a team, that we love to look for change. We love to look for inflection points. We need valuation. We must tick the valuation box. If we're not buying on our terms, i.e. on our prices, we're not interested. We can have many other interesting ingredients, but if it's too expensive, we're not there. So you must tick that valuation box. Ingredient number 1, valuation. Ingredient number 2, change. Ingredient number 3, delta in cash flow, for example. And you're looking for that change or that inflection point at sectors and stocks. And it could be sector behaviour, or it could just be the cyclicality of the valuation of the sector. Pharma is a beautiful example of that over the last 15 years. Everybody's hero in the late 90s, everybody's villain 5 years ago. It was meant not to grow again only 5 years ago, according to various geniuses. Well, it is growing. And all of a sudden, pharma comes in from the cold. It's not actually all of a sudden, it's actually quite gradual, which we love because it's a stealth bull market. And people now see AstraZeneca and other names as immuno-oncology darlings. That's our business. Stocks go in and out of favour, value migrates, and it's all about knowing where to look. You look for change, and what I would say about big sector themes is that they tend to travel. So don't just look in Europe, even though you're a European fund manager. You cast your eyes quite wide.
Now, you've mentioned the European team. Do you take ideas from other fund managers on the European team? Oh,
absolutely. I mean, one of the things that I put in place actually when I came to Henderson is a regular Wednesday must-attend investment meeting. Now, I think those who know me know I absolutely loathe meetings. Meetings about meetings about meetings. So our meeting is a Wednesday. It's 1 hour max. And it's to discuss ideas. And each manager, there are various very experienced managers in the European team at Henderson. Why wouldn't you draw from them? And even the wider Henderson, the global team, the UK people, they don't attend my Wednesday meeting, my team's Wednesday meeting. Within that meeting, Eurocentric managers, if you like, European managers are discussing what they're doing in their portfolios, and the analysts, the bank of analysts in our team are presenting ideas to that platform of managers. And it's up to each manager to decide whether that name, that idea, fits his strategy.
Now, you've mentioned meetings. Do you have face-to-face meetings with the companies that you purchase for your portfolio?
Yes, those are the meetings I do like. And in fact, our job is all about interpreting information. That information can come from a newspaper, it can come from a Bloomberg screen, it can come from a conversation with a taxi driver. And sometimes that actually can happen when you go on the road and visit countries. But a key ingredient for us, a key piece of our raw material is company visits. And again, working with a bigger team, an important pool of assets, Henderson's pretty much a must visit for any European company coming to town. So we have plenty of companies, a conveyor belt of ingredients coming through, of raw material coming through, called companies. And I do want to sit down and eyeball the management as much as possible. So that's where I make an exception to I don't like meetings. I love those meetings.
Now, all investments carry risk. How would you describe the risk with Henderson European Focus Trust?
I mean, I think it's interesting how people define risk, and we've all got risk teams and all sorts of risk oversight these days in our business. And I've always been fascinated throughout my career how people I always thought it was wrong-headed, for example, to say just because, say, Vodafone was 12% of an index, you better own at least 10 sort of thing. And I remember those days. That is not risk control. That's actually adding risk. Risk is about losing money. It's about not coming back, about losing so much money that you can't come back from it. And we must avoid that. So the first risk control I put in is I'm trying to put in a margin of safety in every single stock, i.e. what is my downside in every single stock that I buy. I believe that the single biggest determinant of our success in any asset, a bond, a farm, a building, an equity, is the entry price. That's, for me, the single most important aspect of risk control. If I systematically get that wrong, there's a big risk to investors in Henderson European Focus.
John Bennett, thank you.